Quick question. Rate yourself as an investor 1 to 10. Be honest. Studies show that over 80% of people rate themselves above average, which is mathematically impossible. Here is what is even more interesting. The people who rated themselves the highest, the ones who were most confident, lost the most money, not the least, the most. That is not a coincidence. That is overconfidence bias. And by the end of this video, you will understand exactly why your confidence might be your most expensive financial mistake. Overconfidence bias is the tendency to overestimate your own knowledge, skill, and ability to predict outcomes. It was studied extensively by the same researchers behind loss aversion, Kahneman and Tversky, and later by finance professors Brad Barber and Terence Odian, who analyzed the trading records of 66,000 households over 6 years. Their finding was brutal. The more confident investors traded, the worse they performed. The most active traders underperformed the market by 6.5% per year. The least active traders nearly matched the market. Confidence was costing people money, directly and measurably. Psychologists call this the Lake Wobegon Effect, named after a fictional town where all the children are above average. Surveys show that 93% of American drivers think they are above average drivers. 94% of college professors think they are above average teachers. And in finance, study after study shows that individual investors consistently believe they can beat the market. The reality? Over a 20-year period, 90% of actively managed funds fail to beat a simple index fund. Not some, 90%. Your gut feeling that you can pick winners is almost certainly wrong, and it is costing you. Here is exactly how overconfidence plays out in your investments. You buy a stock because you researched it. You feel informed, confident, so you put in a large amount, more than you should. It drops, but you are confident it will recover, so you hold. And hold and hold. Meanwhile, overconfident investors trade too frequently, racking up transaction fees and taxes that eat returns. They diversify too little, putting too much in a few bets they feel sure about. And they ignore warning signs, because confidence makes you selectively notice information that confirms what you already believe. This is called confirmation bias, and it rides alongside overconfidence like a co-pilot. Here is a finding that nobody talks about. The same Barber and Odian study that analyzed 66,000 households found a stunning gender difference in investing returns. Women outperformed men by nearly 1% per year on average. Not because women are smarter, because women traded 45% less than men. Men were overconfident, trading more, paying more fees, making more emotional bets. Women held positions longer, diversified better, and second-guessed themselves more. That second-guessing, that self-doubt, was actually a financial superpower. The most dangerous investor is one who is never wrong in their own mind. Overconfidence gets worse the more information you have. This sounds backwards, but research proves it. In one study, horse racing bettors were given increasing amounts of information about horses, from 5 facts to 40 facts. Their accuracy in picking winners stayed exactly the same, but their confidence in their picks went up dramatically. More information made them feel more certain, without making them more correct. This is the illusion of knowledge. In investing, you can read every earnings report, follow every analyst, watch every financial news channel, and still not beat a simple index fund, because the market already knows everything you know. Let me put real numbers on this. 2 investors. Both start with $50,000. Both add $500 per month. Over 20 years, Investor A, overconfident, actively trades, pays extra fees and taxes, underperforms by 2% per year. Investor B, humble, buys a simple index fund, barely looks at it. After 20 years, Investor A ends with approximately $280,000. Investor B ends with approximately $420,000, same starting point. Same monthly contributions, same time. The only difference is confidence. Overconfidence cost. Investor A, $140,000. That is not a small mistake. That is a second home, a college education, 10 years of retirement. Here is what separates great investors from everyone else. It is not that they are more confident. It is that they are calibrated. Warren Buffett keeps 90% of his personal estate in a simple S&P 500 index fund, not in individual stock picks. Peter Lynch, who ran the most successful mutual fund in history, famously said that the investor who panics during a downturn is worse than the investor who never invested at all. The best investors are the ones who know exactly how much they do not know. They build systems that protect them from their own overconfidence. Rules, limits, automatic investments. So the confident feeling never becomes a destructive decision. So what do you actually do? 3 fixes. Fix 1. Track every trade you make. Write down why you made it and what you expected. Review it after 6 months. Most people discover they were wrong far more than they thought. The record destroys the illusion. Fix 2. Set a maximum on individual stock picks. Never put more than 5% of your portfolio in any single stock you personally selected. This is not pessimism, it is calibration. Fix 3. Automate the boring part. Put 80% of your investment into a simple S&P 500 index fund automatically every month. Play with the remaining 20% if you want, but protect the 80% from yourself. There is one more piece of this puzzle. Psychologists David Dunning and Dunning-Kruger discovered something that ties everything together. People with low knowledge in a field consistently overestimate their ability. People with high knowledge consistently underestimate theirs. In investing, the beginner who made money in a bull market thinks they are a genius. The experienced investor who has survived crashes knows how unpredictable markets really are. The most dangerous investor is the one who has never lost big, because they have never been calibrated by reality. If you have never lost significant money in the market, your confidence is not wisdom. It is inexperience wearing a costume. The most expensive words in investing are, "I know what I am doing." Not because knowledge is bad, because unchecked confidence is invisible. You cannot feel overconfidence. You just feel right. The investors who build real wealth are not the most confident ones in the room. They are the most honest ones and about what they do not know. Subscribe to The Money Mind for more psychology of money every week. And share this with someone who needs a reality check about their portfolio.